Confused about how to plan for your retirement? Shawn Maloney is here to help. Shawn has created the Retire Happy framework that considers more than just how much you should save. Getting information and tools to preserve your financial future is minutes away. Welcome to the Priority of Retirement with your host, Shawn Maloney.
Hey everyone, welcome to another episode of the Priority of Retirement, where we dive into all aspects of retirement planning for that happy retirement that we're all striving for. Today, I have a fellow advisor with us on the show, Adam Koós, who began his career just 10 days before 9/11. That's kind of crazy right there. We got to talk about that for a minute. But he's navigating his clients through some of the worst market crashes in history. Adam brings a wealth of expertise to us here. He's been doing this for a while in financial planning, market strategies. He's been featured in quite a few financial publications, along with all his certifications. So beyond advising, though, Adam is a passionate speaker, writer, and educator offering financial planning classes and workshops. And what I love there is inspired by his father, lessons on ethics and attitude, which is huge in our business, right?
Yeah.
I love the aspect of education too, because we love doing that. So, hey, I got to know a little bit about that beginning, right?
That's what we're doing here, right?
What a terrible time to start your career. But tell us a little bit about how that went.
I swear people are gonna start watching these guest appearances when I do this, and they're gonna think it's the same thing every time I start. But I always say this, it's always the same start. So I started 10 days before the World Trade Center went down. I was 21. I always joke that I was 60 pounds lighter. I looked like I was 16, and I was going door to door, business to business, trying to get people 3 times my age to trust me with their life savings when the market's precipitously falling. So it was not an easy time, that's for sure.
You definitely went off in a rough time. You earned your keep, though, right?
That's true. Yeah, cut my teeth, one of the two.
There you go. That's definitely not only drinking from the fire hose, but you had everything going against you there. Well,
not easy.
Yeah, not easy at all. Well, I appreciate you coming on.
Thank you for having me.
Yeah. So, we both talk about education. I think we're both passionate about that side of things. But when people hear about the financial industry and you hear all the stuff that goes on out there, I love the aspect of the ethics-driven approach and client relationships. So tell us a little bit about, kind of the technical expertise with the personal flair tied in with the ethics-driven aspects of it.
I don't know. I think from a very young age, I really haven't overanalyzed it like I'm about to right now, but I think from a very young age, I remember my dad always having these conversations with me about what's fair and what's not fair, and that life isn't always fair. Yeah. I was very principle driven when I was a kid, and I just, when things wouldn't go the way they should in my eyes, from a fairness standpoint, I would kind of lose my mind about it, maybe lose my temper. Yeah. And he would just always tell me that life isn't fair. You have to learn to roll with the punches, play the game. And I hated that, but it's the truth, unfortunately, a lot of the time. So, but as it pertains to ethics in our business and just business in general, not just our business, when I started my company, I was 25. It was November 4th of 2004. And I remember asking him, because he was a successful optometrist, had his own practice. And to this day, I've always admired him. He's always been my biggest idol. He's the person I've always wanted to be like. And I just, I remember asking him, like, hey, I know there's tons of advice you could probably give me, but if you had one piece of advice, one thing you could tell me that would, help me be successful like you've been with your practice, what would it be? And he says, I would just pretend like everything you do is in tomorrow's front page and the rest will take care of itself. And so that's kind of how we've, built this thing from the ground up, from literally 0 clients, 0 money, racked up credit card debt, reinvested in the business, is pretending like everything's in tomorrow's front page and that everything's on blast for everybody to see. Yep. And I could have made a whole lot of more money earlier in my career. I could be a whole lot richer now, right. If I would have done it the wrong way. But I'm not the kind of person that could have slept at night if I did it that way. So I would say that's the first thing. And then the other thing is just a constant, mantra inside of our office that, we always say constantly. We're always saying, if it weren't for our clients, we would not exist. And that's not a one-liner. It's true. Like it's like going out, my wife and I have been playing volleyball for, 18 years, sand volleyball year round. There's an indoor place we play every Thursday night. And I'll never forget, like, I don't know, 8-9 years ago, we're hanging out at this place called JT's. We hang out at every time we go play volleyball, we hang out at JT's after, eat chicken wings, have a couple drinks. Right. And I remember this friend of mine saying, must be, we're talking about business and work, and they were having maybe a bad day at work, and he says, must be nice not having a boss. And my response was, at the time, oh, I was like, I've got about 250 bosses. They're called clients,
Right.
and they're all different, So
Yeah,
anyway,
yeah, I love that. No, that's spot on. I mean, and you know, it, in the way that ties into the relationship side of things, if people know, that you're being transparent and that you're just upfront, having those great, honest conversations with them. I mean, that's what keeps people as clients, and that's really what I think we all strive for, is to have that personal, relationship side of it. Is you get to understand everybody, and the transparency part of it is just enormous, right?
I don't think it's unlike, we're not respected to the level of physicians, right?
Sure.
I think we're somewhere underneath physician and CPA, somewhere under there, above car salesman, I think. I think that it's not unlike a physician though, where people like we all go to the doctor, when we're sick or we're worried about something, and we trust that person. And
Yep.
if it's just a sickness, it's one thing. But if it's surgery, if it's something, like I've had surgery in my life, and you trust that person to give you the best treatment and take care of you, because they're doing something you can't do. You don't
Yep.
know how to do it. You don't understand it. And when you're in the middle of the surgical table, you don't want somebody, waking you up to check on you and see, hey, what do you think? You probably need a new surgeon. But that's
Right.
what it's like, I think, a lot of times in our industry, is that people need us to do what's best for them. And unfortunately, not everybody practices that same mantra.
Yeah. Yeah. Unfortunately, and so sometimes that's an uphill battle, right? But as long as we
Yeah.
stay true to us and true who we are, then we know we're good, right?
True story.
Yeah. Yeah. Well, you mentioned, or we talked about education a little bit, and getting the right information out to people. There's a lot of let's just face it, the internet throws a lot of stuff out there, right? There's people have a lot of information at their fingertips. I'm sure you hear a lot of different stories or ask people asking you questions about, hey, what about this? Have you heard of that? So tell me a little bit about how important education is to the work that you're doing with you and your clients, your community, and also through your writing and speaking.
I think that education is probably more of what we do than people realize. I
Yeah.
think that education is the root of everything we do, because what people need these days, it's not like the old days where they want to be sold something or
Right.
sold an investment, and they want solutions-based advice.
Yeah.
And I think that people want to be educated. If they're a client, then they probably already trust you. But if they're not a client, they want you to help them understand before they even think about making a decision to
Yeah.
work with you. So I think that we have to. It's our job as advisors to educate the public, sift through all the noise, which there is, as you just put it. There's no shortage of noise. I mean, everywhere you look now, whether it's a TV, a radio, a cell phone, I mean, you've got all this news and this noise at your fingertips. You've got blanket advice by people writing books, and a lot of the advice doesn't make sense for everybody.
Yeah.
But I think that yeah, no, for me, I think what I truly enjoy is teaching and kind of giving away the farm for free.
Yeah.
And I think that the fun part is kind of sharing with people the myth busting kind of things. Like, here's what you might see, but here's the truth.
Yeah.
You
Right.
might think this, but here's the honest to God truth. So
Right.
so anyway.
No, I'm with you. I'd rather state all the facts, educate people. That'd be fabulous if they end up working with you or me. But at the end of the day, if they walk away better educated and making smarter decisions for their future, then that's a win, right? Obviously we always want to work with people, but that to me, that's the prize behind it. Hopefully we have those relationships, but I love that. I
Yeah.
actually, well, here's a loaded question, right? So, especially
Uh-oh.
with the way things are going on today is with markets and those kind of things. So when we look at retirement and strategies about retirees looking to preserve their wealth and protect their wealth a little bit and make their money last, right? The number one fear in America when people talk about retirement is, hey, I don't know that I'm going to have enough to make my money last.
Yep.
So tell us a little bit about how you guys go about that and strategies that you guys talk about, in that regards.
Yeah, I mean, it's funny you say that, because after we just talked about education briefly, but it's the first part of it's education. I mean,
Yeah.
I literally had one of my financial advisors come in here a second ago, and we've got somebody who's retiring. Well, technically their job was eliminated, so they're thinking they might not go back to work.
Yeah.
So it's a couple. One just got laid off, couple months of severance. Then, do I want to keep working? Then the spouse is working still, doing very well. And we do this thing we call guardrails. So in every financial plan review, we have this slide, and at the top it says, on the upper left, it'll say total AUM or liquid net worth, like LNW.
Yep.
And then it'll say current withdrawal rate, and it'll have a dollar amount and a percentage. And for this couple, it's zero right now. They're not taking anything out. But then we'll have three calculations underneath that. And the first one is a pretty complicated calculation. It's 1 divided by the number of years you have left to live, divided by 12. And that gives us a monthly, really conservative withdrawal rate, unless you're 85.
Right.
If you're 85 and you follow that math, then you're taking out like 25% per year. That's not a good idea. But for the people in their, late 50s, early 60s, mid 60s, late 60s, I think that makes a lot of sense to use that as a really conservative withdrawal rate. The second one is a moderate withdrawal rate, which is just simply 5% per year based on the portfolio balance. And then the aggressive one at the bottom is 6%. And we always tell people those are your guardrails. The most conservative one, obviously, is 1 divided by the number of years you have left to live. And then the most aggressive is 6. You start getting up to 6, we're not real happy about it.
Yeah.
Because that makes our job a whole lot tougher, especially during market drawdowns. So if you look at the average crash, because it's called sequence of returns, right? You know this already.
Of course.
If the average crash is 42%, let's just say 40%, just to make numbers easy.
Right.
And if the average crash lasts about 16 to 18 months, let's just call it 2 years, because the last couple were 18 months, 2000, 2001, 2002. I'm sorry. Yeah, that was 24 months. Then 2007, 8, and 9 was 18 months. Obviously, you could say 2022 was 12 months, we'll say, maybe 14. But anyway, so let's just say 40% drawdown is the average market crash. And then the length is typically, say, 2 years at the most.
Right.
If you take out 5% per year from $1 million portfolio, that's $50,000 a year, right? So over 2 years, you've taken out $100,000. But all things held constant, if you've lost 40% of your money, you now have $500 million. So 100,000 withdrawals, $400,000 in market loss. The problem is now your withdrawal rate's 10%. 50,000 on $500,000 is 10%, which means our job now all of a sudden becomes we have to break even at 10% net after fees and taxes, which is not easy to do. I mean, I'm saying that can't take that lightly. Right. So I think most importantly, I think we have to, as people close in on retirement, I think part of our job is to ensure that we're being more and more conservative, but not in the traditional terms. I think that people have been taught incorrectly. It was all with good intent, but the industry has taught people that they need to buy more bonds. Yeah. I think we live in a different interest rate environment now where, if the Fed's going to raise rates, which they're not right now, but if they were, and they did, right, from 2022-ish through last year.
Yep.
It is not a matter of speculation. It's not if bonds will go down. They're going to go down. I mean, So in that place, I think you want to shorten up the yield curve. I think you want to get, super, super short term on your durations. Yep. And you just want to put it in risk-free assets, So I think that, but at the same time, I do think that there's 2 ways to manage your risk. And I think risk management above all is most important. A is through the pie chart. So whether you're aggressive, moderate, balanced, conservative. And the second way is just how tactical you are. How much money is in cash, or as we like to call it, gunpowder.
Right.
If you're a retired client and you're taking withdrawals, I don't think it's a bad idea to have 2 years of gunpowder so that when, not if, but when shit hits the fan, that we've got that gunpowder to live off of so we can turn off the oven, or not turn off the oven, but let the cookies bake, and give it time.
100%. I mean, and it's, you hit it right on, because it's not hey, you create a plan and you just live by that forevermore. Things are going to happen in the market, in the economy. There's going to be policy changes. There's going to be, market fluctuations. There's going to be interest rate changes. And so some of the traditional things aren't always going to carry you throughout, right? So not to be cliche-ish, but it is a journey along the way. So your plan may get adjusted along the way. And yes, there are, like you said, you hear about bonds and those kind of things, but there's a lot of different alternatives, and it's not a one size fits all, right? I mean, you work with a lot of different people, and I'm sure you put together tons of different kinds of plans, right? Everybody's retirement is theirs.
Yeah.
Right?
It's like a fingerprint. Yeah. Everybody's 100%. Different.
Yeah. And it's, I've seen people come in, like some people get second opinions and those kind of things, and they show you a plan, and it's like, well, when's the last time that they went over this with you? And it's been a minute. I said, well,
usually.
Yeah,
especially times like now. I remember early in my career, I'll never forget this. One mentor of mine told me that it's times like now where financial advisors curl up in a fetal position and hide under their desk.
Right.
And it's true. And so I think the step, our job again, we have many jobs, I think, but
Sure.
I always joke, I've got a finance and psych degree, but I feel like I use the psych degree more than I do the finance degree.
Right. Yeah.
Um,
Yeah.
but I think now is the time to, now's when we get paid.
Yeah.
Now's when we earn our money, right?
Yeah.
When the market's going up, nobody really calls, nobody cares, everybody's fine.
Yep.
But when things inevitably pull back, the average market goes down 5% on average 3 times a year.
Yep.
It goes down, an average, 10% once a year. It goes down 14% on average every 18 months. And we had not seen and more than a 10% drawdown since this bull market started, almost two and a half years ago. So
Yeah.
I was writing, speaking of education, we do a monthly market brief every month. And I was writing in the beginning of February that in a post-election year, February and March tend to be the worst months of the year.
Yep.
So expect to open your statements in March and see a negative number.
Right.
And just throw it away. In fact, don't even open it. Just
Right.
use this to start a fire in the backyard. Enjoy the weather changing,
Right.
and don't worry about it.
Right. Yeah.
Easier said than done, right?
It is, well, because people are obviously emotionally tied to their money because it's their future. But that emotion side, as those emotional decisions can be catastrophic, right? If
Oh,
you
yeah.
don't have someone in your corner bringing you back to center, and back to education, let's look at the facts. Let's look at where it's at. It may justify moves. It may not justify moves.
Mm-hmm.
I remember talking about psychology and the emotions of it, and I can't remember who created it, but there's this investor emotional chart.
Oh,
right?
the continuum of investor emotion. Yeah.
Yes, yes. It's hysterical, to look at the different emotions through the different peaks and valleys, and I love looking at that. We use that. We share that sometimes, when we're talking to people or putting together workshops, that kind of stuff.
You'll have to when this is published, you'll have to replace our faces with a picture of this thing just to show people what you're talking about. Yeah.
No, it is fantastic.
But it's interesting. I want to make sure I say this because I just popped into my head as we were talking about emotion. So 2 weeks ago, we had two clients, one of them who just recently hired us, call us up. Another client had been with us for a while, at least a couple of years. Both of them called us up a couple of weeks ago and says, I can't take it anymore. Let's go to cash, sell everything.
Oh, wow.
So we sold everything and we went to, and their portfolios are cash. They're locked. We can't trade them until they tell us otherwise.
Right.
We've got another client who said, call me up and said, let's take 15%. He wants to be a little bit more conservative. So I think he realizes that he needs to let me do my job, but he's still very fearful. So he said, let's go 15% per cash per week for 7 weeks till it's all in cash. On the other hand, we have a client who's got $500,000 in cash and another one who's got about 4 million in cash. And they called us up and said, this sounds like a great time to put money to work. And they put it all to work.
There you go.
Does that not outline the tails on the Gaussian bell curve of investor emotion?
100%.
The pain of loss, prospect theory, right? The pain of loss is much more painful than the joy of winning. And that's what we're dealing with right now.
Oh, yeah. 100%.
Another thing that I find really interesting, I was talking to a client this morning over coffee, very concerned about political environment right now.
Yeah.
And I was telling her, I said, one of the reasons I don't watch any political news is because I have to stay robotic. That's our job, right? We have to look at things through the lens of, objectivity. Sure. And when you look, ironically enough, when you look at the market, the stock market, the S&P, the NASDAQ, a year ago, March of last year, the market went down about the same amount in about the same amount of time. The only difference is what's on the TV.
Right. Yep.
But if you, and I said, imagine this. Imagine there were no news, cell phones, smart, we didn't have apps at our fingertips. There was no radio. All we could do is stare at a chart on a screen. Yep. What we would be saying right now is, man, I wonder what's happening.
Right.
And last year, what we would have been saying is, man, I wonder what's happening. But that's it.
Yeah.
Right.
Yeah. And of course, all that feeds back to the emotional side of things because people get all this data and all this information is just flooded into their head and it creates confusion. And people react off of, let's just say, speculation and,
not worried.
Fact. Yeah. Yeah.
They're worried and justifiably so. I get it. Yeah. I get it.
Totally. And I know I can speak for myself. It's probably you as well. But when you're talking to someone and you're looking after, their future and their funds, it's easier to stay objective. But as soon as you put your future in the middle of it, It's a
Yep.
little bit different, right? I mean, even though we're both trained and we both have that mindset, but when you're starting to talk about you and your family, it's more emotional,
It's
right?
different. It's different when it's your money, that's for sure.
Yeah.
I think the the fortunate circumstance you and I have is years and years of experience of managing other people's money. So you can be a robot. You can turn your emotions off. And she was asking me this morning, same client. She's like, I'm just curious. Like, and she leans forward. She's like, I'm just curious. What are you doing with your money though?
Right.
And
Right.
I don't know how you do things, Shawn, but I said, my money is in the same models you are.
Yeah.
In fact, got a great, hilarious story. It wasn't funny then, but I got a great story to share with you. Back in 2011, U.S. Treasuries, being threatened to be downgraded by Moody's or S&P.
Yeah.
And that Thursday night before the weekend that it was downgraded, I'm in my outside on my laptop doing research. It was just a nice night, August. And everything I'm looking at says, man, I'm like, I'd rather be out of the market wishing I were in than in wishing I were out.
Right.
And our tactical portfolio models, so our trend following models are already probably at this point, maybe 40% cash. And I'd never done this before and I've never done it since, but I just arbitrarily said, that's it. I'd rather be out wishing I were in than in wishing I were out. I can always make it. If I'm wrong, I just don't stay wrong. Right. Nothing wrong with being wrong. Just don't stay wrong. So
Right.
we go to cash, all 100% cash. I got lucky, at the end of the day, luck doesn't hurt. The U.S. Treasury gets downgraded. The market goes down 20% over the next, 20 trading days.
Yeah.
And I'm feeling like a hero, feeling good. Market starts coming back in October. We're buying on the way back up the hill. And then it hits me when I start to go back and buy that I hadn't placed any trades in my own account. Totally forgot about my own money. That was 2011 August. That I will never forget that because that was the day I moved all of my money into our portfolio models with the rest of our clients because I was just so busy that I didn't think to place my own trades.
Yeah. I love that. That's totally great. Well, I don't know if you work. Sometimes we've had a couple episodes where we're talking about business owners and those kind of things. And it's just a different world, right? I mean, if for those of you out there that have your own business and you don't necessarily have all the same, 401ks and all that, it's a little bit different for entrepreneurs and people that own their own business. But I think what's really important though for people to think about early on, even if you're just starting a business, is what does that exit plan look like, right? And how does that affect your retirement? Because at the end of the day, at some point you want to retire, and I think a lot of people wait too long to think about their exit plans and their retirement. When they're starting that business.
For sure.
So what's your take on that successful transition and exit planning?
God, that's another podcast, Shawn.
I know. We'll just give us a Reader's Digest version.
I can still give you Cliff's Notes, Reader's Digest, whatever. I feel like all these things are making us sound old, by the way.
Right.
What is it called now? The summary, I guess, is it the Blinkist version? I guess
probably
this version. Yeah, I mean this is something I'm really passionate about, and it all started during COVID because we're at our office. We usually have on average about 25 appointments a week, and then COVID hit. And we had 8 appointments in 8 weeks. I'm sorry, 3 appointments. So 3 people met with us over 8 weeks. And it got slow. I mean, we installed some new initiatives that we didn't have time before to do, but we ran out of time. We ran out of stuff to do. Happy hour just got earlier and earlier every day.
Right.
And so I started just reading more. And I read this book called Walking to Destiny by Chris Snyder. And the stats in the book just absolutely blew my mind and frankly kind of upset me, made me mad. And the stats are this: 80% of business owners' net worth is tied up in their company. And every time I say that, the person I'm talking to shakes their head just like you did. Does that make sense, right? It's about right.
It does. Yeah.
Here's the other 80% that isn't so great. 80% of businesses don't sell, they dissolve. In other words, the owner spends their whole life working and they get nothing for it. Their family gets nothing.
Yeah.
And when you consider that it's 80% of their net worth, that means 80% of their net worth is gone.
Right.
And the reason I say that pissed me off is because I thought back to times like, I started my career in 2001, and things were going, did okay for a while. And then they got great in 2003, 4, 5, 6, 7. Market peaks start going down again. 2008, I'm coming home from work and I'm giving my wife a kiss. And then I'm sneaking into my home office to try and sell things on eBay, like finding anything I can do to sell things on eBay to pay the mortgage.
Right. Yeah.
Because I had to choose between paying the mortgage or making payroll. And I chose payroll. I chose to pay my employees. So when I thought that 80% of businesses just go away when you think about moments like that, the tough times, I
Right.
just wasn't having it. So the last statistic is that 75% of the 20% of businesses that do sell for less than market value. And the reason is because, to your question, to your point, it's because they don't plan. And I think that it's financial planning is becoming a bigger thing. I think that thankfully people are becoming a little bit more proactive about retirement readiness, and that's wonderful. But when it comes to business owners, I don't think it's caught on yet. Honestly, I don't think that
Agree.
it's very rare that I meet a business owner that doesn't have the attitude of, oh, I'm not ready to sell, so I'll worry about when I'm ready to sell.
Right.
And what ends up happening is they put it off too long, and either they there's a disease. They talk about the D's, right?
Yep.
Disease, divorce, death, just disagreements with partners. I mean, there's all these things that can derail, not to use another D on accident, the whole sale of the company. So I think that the answer, there's two answers. If you want to sell your company and monetize your life's work, you should start planning 3 years beforehand, minimum.
Yep.
If you don't start planning 3 years beforehand, there's not much that Shawn and I are going to be able to do for you, frankly. We can maybe do a couple little things here and there, but generally speaking, where you're at is where you're at, and you're not going to see the needle move.
Right.
If we get 3 years or more, we can probably increase the absolute value of your company combined with your multiple enough to increase your total sale price, but by between 20 and 40%, just depending on how much work we get done in that 3 year period. But plan for a year, implement for 2 years,
Yep.
and you'll see things change dramatically. And you'll be really happy and content about walking away from that business and knowing you did it the right way. The second part of the answer is it doesn't matter if it's 3 years or 13 years, you should start planning now. And the reason for that is a lot of the things that we implement at the end of, toward the end of a business owner's working years are things that help get the business owner out of the business, or at least spending less time in the business. It reduces customer concentration. It creates continuity plans. It makes the staff happier. You increase your profits, and you have more free time and work-life balance. And then as a result of all those things, it's the time value of money and compounding interest, right?
Yeah.
Then you just grow faster, and inevitably you're exponentially going to be worth more at the end of the day. So, but I think the hardest part is business owners really struggle to spend time on their business in that way because they're just so busy.
100%. I mean, and you hit it right on the head. I mean, the ironic part is the things that you get started in your business, and I'm sure you've experienced this. When you first start your business out, you're all about, let's get going, let's start turning a profit, let's make, get that sale, whatever it may be, right? And you often forget the foundational components of what's going to make your company strong. And a lot of times you keep on pushing that off until, oh, I'll get to that later once we're going, right?
Yeah.
And everybody, just like a lot of people do with retirement planning, that keeps on getting pushed down the road. And before you know it, you're 10, 15 years down the road
Yep.
and you haven't done anything, right? But to your point, all those things make your company more sellable, right? And like you said, your employees more happy if you're running a more efficient shop. And it's easy. I know it's easy to sit here and tell people that, and people listening to this like, yeah, okay. But it really is true to, carve out time. If you're going to time manage it, carve out some time to make that a priority,
Yeah.
part of running your business.
It's like getting in shape,
Yeah.
It's like you have to want it bad enough, first of all.
Yep.
And the pain of, being out of shape and feeling miserable has to exceed the pain that it takes to get in shape.
Yep.
And then chances are you're probably not going to be able to do it on your own especially if you've tried several times before and failed, which is where someone like you and I come in and build a plan. That's like the diet and exercise plan. And then honestly, the personal trainer is your fractional CFO that comes and holds your hand and walks you through the plan.
Right.
So, yeah.
100%. 100%. Well, we're going to round it out with this, and I love this topic of things. The retirement, not just being about the financials, right?
Yep.
And we all work hard our whole lives, and we save up, and we create that nest egg to have that, what we say, the happy retirement, right? But there's more to preparing for retirement than just the financial side. First of all, I'm a firm believer in that, what you want to do in retirement, let's figure out your funding of that, but let's figure out what you want to do first. But then that's a big mindset transition. Let's set that aside for a second. There's a financial mindset change because you change from saving to spending, and that's hard for some people.
Yep.
But there's also another mindset that changes. It's an emotional side of it because it's a change of life, right? It's a lifestyle change. It's an emotional side of it as well, outside of the financial pieces. But I love to get other advisors' take and inputs on that as you talk and work with clients, how you factor that in and how you work with people on the non-financial aspects of retirement.
Yeah, I'll say two things. I'll say the first thing we often say to our clients when they're getting close to retirement or they've just retired, or even if they are retired already and they come in, they're not spending money. We want them to spend their money. I mean, and then most people, when they think about their goals, their retirement goals, they only think about the first 10 years. Yeah. Like it's almost all that's as far out as they can go. Almost like you can't see beyond that first 10 years. But these days, life expectancy is, 88, 90, 92. And if you're healthy, which we all want to be, maybe you live longer. So what about the second 10 years and the third 10 years? What's that look like? Now, maybe you're not doing as much traveling the world and hitting all the continents, but maybe there's things you really want to do with and or for your grandkids, and really making a positive effect in their life. So that's the first thing I'll say. And the second thing I'll say is a quote I learned from a good friend of mine. And I don't know where he got this, but I've never heard anybody say it before. And we say it all the time in our office. And that is that money is a unit of choice. And the more units you have, the more choices you have. So it's not the root of all evil, and there's nothing wrong with spending it. No. It's just a unit of choice. So there's a reason we save all this money our whole lives, and that is to spend it on things so we have choices and we can have fun and enjoy that the choice that this fortunate circumstance offers us with our loved ones and the people we care most about.
100%. It's a tool, and it should be used that way and used properly, right?
100%, man. Yep.
Man, it's been a pleasure having you on. I got to do the disclosure here at the end that, Adam and any guest of the show, aren't affiliated with myself or RetireWise, nor do we endorse each other back and forth. Let's get that out of the way. But it has been a pleasure having you on, Adam. Yeah. We'll stay connected. And guys, here's to aligning your future for that happy retirement. Me and Adam wish you the best. If you have questions or concerns, hit either one of us up. We're happy to talk to you. Until next time, have a happy retirement and a fantastic day.
Thanks, Shawn.
Thanks for listening to The Priority of Retirement with Shawn Maloney. If you enjoyed the show, check out our reviews on Apple Podcasts, Spotify, or wherever you get your podcasts. For more free resources to help with your retirement journey, go to retirewisepro.com or check the link in the show notes. You can also download a free copy of Shawn's book, The Priority of Retirement, or reach out to discuss working with him directly at retirewisepro.com. Thanks for listening.
Insurance products offered through the insurance business RetireWise LLC. RetireWise LLC is also an investment advisory practice that offers products and services through AE Wealth Management LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by RetireWise LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the insuring carrier. This podcast intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. RetireWise LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by RetireWise LLC. Guests of the Priority of Retirement are not affiliated with, nor do they endorse Shawn Maloney or RetireWise LLC.